FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Financial Survival Network is brought to you today by Orin Resources, a junior exploration company with the appetite of a major. It's hot on the trail of the next globally significant discovery, creating enormous potential upside for you, the shareholder. Orin is one of the most aggressive exploration companies pursuing high-grade, scalable gold and copper deposits and has a premier 7-project portfolio, including its 2 flagships, Committee Bay in the Arctic and Sombrero in Peru. Orin's unparalleled technical team and highly experienced management has a history of success in advancing and monetizing exploration assets. No wonder Orin's been called one of the best in the junior exploration sector. Orin trades on the TSX and the NYSE under AUG. To learn more, go to orinresources.com. That's AURYN resources.com.
The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 5/2/19. Yes, that's right. It's the day after May Day. So I know that all of you Bernie supporters listening now, well, probably not many of you are, because it's still early in the day for you. You're probably hungover from the May Day festivities. So, hey, but for those of you that are here, peace. We love you, comrades. For the capitalists among you, forget what I just said. Anyways, if you want to be a part of the show, as always, email us, kl@kerrylutz.com. Markets. So we're at peak markets. That means everything is going great. The country's doing incredibly well, and there's absolutely nothing to worry about. Just like Alfred E. Newman used to say, what, me worry? Well, hey, let's get a better picture of what the market's doing and somebody who's actually in the hot seat, who's there on the trading floor. His name is Bill Baruch, and his company is Blue Line Futures. You find him at bluelinefutures.com. Bill, welcome to the show. And hey, what are these markets trying to tell us now?
Well, thanks for having me on today. We're seeing things get digested from after the Fed meeting, and they tried their best not to do anything yesterday, and I'd say they didn't do anything. But what we were seeing is markets price in what they wanted to hear, and what they wanted to hear was a continued more dovish rhetoric. We've seen the CME's Fed Watch tool price in the odds of a rate cut this year, getting nearly up to 70% chance in 2019 that the Fed cuts rates. Which is, I think, really overdone at this point, especially given the 3.2% GDP, regardless of any asterisks with that GDP number. It feels like we've avoided a near-term recession. What they did yesterday is, again, they try not to do anything, but Fed Chair Powell did allude or did say that inflation was the slower inflation was transitory. And, we've all seen the numbers. Inflation's been dissipating since the middle of last year. But, he pointed out that being transitory, that means they expect it to pick up. And if they expect it to pick up, then they're going to be less dovish, as the thing is we're heading into what typically is a seasonally bullish time for the economy. We get out of this slower quarter 1 rut at the end of April, and we see things pick up a bit in May and June. It's typically how it works. So the markets are doing what they should do, not price in a rate cut to the extent that they have, and look at getting more neutral on the Fed, and that's what they're doing. And where equity markets get a little overextended, bullishness at times, that's coming in a bit too. The unfettered long risk that funds are taking just because there's ultimately a Fed put below the market, they've pared back some positions. So yeah, nothing too much on the equity side. We're down about 1% from the highs. I'm looking at the commodities a little more closely today, and the fact that crude oil is getting smoked. But the one that not many people talk about enough is copper. And my narrative all year has been fading rallies in copper because regardless of what the U.S. is doing, I do think there is reason to believe that the global economy is slowing, and we've seen that through the China numbers. We've seen that through German manufacturing numbers, which was actually revised lower today. So I think rallies in copper to $3 have been something I've been talking about for months now, and fading those. And copper is just I think it's telling us there is some more issues in this economy than we would otherwise believe around the globe, and that lost 10 cents yesterday. So I think that's got to be on everybody's radar as well.
That's a pretty big hit, and China is responsible for 50% of the world's copper consumption, and nobody knows how much copper is sitting in warehouses, bonded or otherwise, in Shanghai, and how many times it's been hypothecated to how many different lenders, cross-collateralized, et cetera. Hey, so commodities, we don't get a lot of people on the show who are really into commodities, but being that you're in Chicago and you're there, agricultural and pork, I haven't seen it go up. I haven't seen my deluxe ham go up, my Boar's Head deluxe ham go up yet at the Publix. But we've got an epidemic of African swine flu, and we got China scrambling to buy every last pork belly it can, and there's only one place they can buy it from, one place that has surplus, and that's the good old US of A. What is your take on pork?
We're bullish. We're bullish on this pullback here. If you look at the front month June contract on a technical basis, I mean, we have a higher low in this sharp pullback compared to what we saw in April. We're holding the 50-day moving average on this recovery here for the next 2 days. I mean, for us, we're bullish here. We're positioned long with our clients, and I'd have to say more than 60% of our business is agricultural based. We have a lot of hedgers here, and we're bullish on hogs here over the very intermediate term, and we could see this front month June contract make a good run at 100. It failed there just a couple weeks back, but we see that in the crosshairs here around the corner.
Yeah, I mean, a couple 100 million hogs have been slaughtered because of the African swine flu. There's no cure for it. It's kind of gone around the world. Thank goodness it hasn't hit the U.S. But
yes, you said it. If it hits the U.S., you look out. And you're going to see prices really skyrocket. That's where the risk is. That's where the risk is, because you could take defined risk and use options, call options on hogs, and really play the long side. That's something we've done here.
Mm-hmm. And the reward, if it hits here, all bets are off. It could double, triple, even go up even higher, a bubble kind of thing, emerge almost overnight, of course, that nobody is ever expecting, right?
Correct. Yeah, you said it. That's where that is where, if you play this, that's where the risk is. That's what we're here to do. We're here to take define risks and look for the larger rewards, and the hog market is providing that right now to traders. And the other thing we want to look to is if it spills over into the strength in cattle, and that's something that really could wake up as well.
Yeah, because substitution, price of pork goes too high. Although I don't know, what cattle's been hit really hard over the last several days. It's been one of the most beaten down commodities on the board. So this is, if somebody's looking to spread a little bit of exposure around, this is the time to do it. Hey, so I don't know if you watch that show Billions, but they make a play.
I do.
Okay, so they made a play in the last show. I don't know if you caught it, on chickens, trying to corner the market on chickens. There is no way to play the chicken market, is there, through the exchanges?
Well, there is I'm ashamed of myself for not looking into it after watching the episode, just for the heck of it. But there's a lot of things over the counter, and I'm sure you can probably find a way to play it one way or another. But it's not as far as I know, a CME traded product. It's not what we do here.
Exactly. I guess you could get Lloyd's of London to write a contract, or AIG, or one of the brokerage houses. But then you got to find the other side of the trade, because they're not going to sit with it, right? So I'm watching it, and I said, this is just television, and. But problem is, so many people can't tell the difference between television and reality these days. It seems so real. So
it does.
So metals, all right, gold, silver, platinum, palladium, gold, silver getting slammed again today. It looks like they're heading back down to 1,200. You got an opinion on it?
Well, I've been bullish gold overall, and we're traders though, and we don't trade what we want to see. We trade what the market is telling us.
You're agnostic.
Yeah, and really, what this thing, it's been trending lower. We've had some two lower peaks since February in gold. There is a lot of support down below the market. We were extremely bullish during the more seasonally bullish time of year to be bullish. And that was at the second half of December and through January into the first part of February. That is when you need to be long gold. It's worked almost, I'm throwing a number out there. I don't have my statistics in front of me, but something like 11 out of the last 13 years.
Yeah, it's 70% overall, but yeah.
Yeah. That's what you need to be. And if you're just clinging to positions without taking anything off the table after that year, each year you've taken a big hit. So there's going to be a buy opportunity in gold at some point. Right now, we're trending on the lows, and the dollar is strengthening. One way, I do think the dollar can move up a bit here, depending on what happens to non-farm payroll. So there's still some risk with gold to the downside. One thing you do want to watch, though, is there's a potential decent descending wedge pattern forming in gold.
Correct.
And if it doesn't really fall apart, that could lay the groundwork for a more upbeat technical pattern over the coming months. But I think the damage here we've seen, we're going to have to see that June contract come off the board, which really means that we're not going to see really gold move big up one way or another really for the next 3 or 4 weeks at least.
Okay. Now, here's one market that nobody gets. Well, there's 2 markets. They're both exceptionally tiny. Actually, there's 3 of them, but we don't even talk about the third. Platinum. All right. There's it's a minuscule market. And then, of course, palladium. But what we've had is this anomalous situation where palladium's been trading for an ounce of platinum has been trading for less than an ounce of gold for years now. And then palladium took off. It broke 1,500. I think it hit 1,540, if memory serves me correct. It's pulled back now. It's in that mid 1,300 range, still far higher than platinum. What is your take on these 2 markets?
I think they're going to have to converge a bit. But I mean, there's no time that we really, you can't sit here and put a time frame on it. I mean, the swings in palladium, they're not for those who are can easily get sick to the stomach, because that's exactly what this thing can do. I mean, we saw a $100 swing just this week, and I mean, just on the futures contract, that's a $10,000 move in one contract. Yeah, that's huge. And so, I mean, when something has that type of volatility, you look back at Bitcoin. I mean, even if somebody was really trying to sell Bitcoin, obviously there was a good peak to get short there if you had a means to do it with the CME exchange. But the volatility on the way up, I mean, you don't know where you're going to find that peak, and that's sort of where we are with palladium right now, because it can definitely go higher. It's definitely showing that it's trying to peak out, but there's been a lot of support down at 1,300 for quite some time. And you think that this thing was about to roll over through April, and then all of a sudden it rips $150 to 1,450. So it's a tough one, but platinum's now really following the other metals down, and it's been a bad 3-day stretch for platinum. It's well below gold too, so it's sort of that. Where, same thing with silver. Silver's always thought of as the redheaded stepchild of gold. It's platinum really becoming the same sort of scenario here, because they're neither are getting any love. Long term, I mean, there's going to be some great value down here. I think silver anywhere around $14. I mean, we're below 15 now, but I mean, you're getting down to the point of where this is actually the cost to produce it. $13.5 to $14. So there's definitely some great long-term value and support down here. And, I think platinum, has a bit of ways to go, where we had these recent lows. I mean, it was down to 790, well below $800. I mean, so there is at least another $50, $60 to go in platinum to get down to those lows. I'm not saying right now that it has to do that, or it is going to do that. I did lay that landscape out when I'm watching for gold, but there is going to be some long-term value down here somewhere.
All right. I'm agreeing with you, but it's been going on for years. And as the saying goes, the market can remain irrational longer than you can remain solvent, of course.
Exactly. There you said it. Yep.
Yeah. And so getting back to Dr. Copper, all right. So yeah, taking a hit, it keeps flirting with that $3 resistance range, right? And it keeps pulling back, but it doesn't pull back much. And like you said, it's an indicator as to the health of the world economy, but it's been treading water there. It's kind of like a really kind of narrow channel there, isn't it?
It really did break down from this yesterday. I mean, we were in this consolidatory period, $2.85 to $3, and I mean the rallies were $3. They were some just tremendous fades because on those days it left tails. Now copper for a long time it was in a period of just very, very low prices because the industry was flooded with low grade copper. And it's dug itself out of that, really around the 2016 election and a lot of the infrastructure going on. And overall, the economies are coming out of that early 2016, late 2015 slowdown. The Chinese yuan had gained back some value. You saw copper come out of it. And so, yeah, I mean, this breakdown in the near term, that $2.85 to $3. I mean, it breaks it down to that recent shelf, which really 260. I mean, it's in the crosshairs here, and I think ultimately we could easily see 260 this year. One thing you do want to watch out for is something like the infrastructure bill getting passed, and if there is a bipartisan bill that gets through, sometime here, that could be something that you want to watch out. Just because you look back at the 2016 election, and Trump was going to be putting a lot of it into infrastructure. That was a big catalyst in moving copper. So that could be something that could shake off this sell-off. But right now, the technical basis, this is a breakdown. This really is.
It's a real breakdown.
That's what we're looking for.
Interesting. Yeah. So that's a kind of wait and see though type thing. Well, we'll know more when it takes place. And I'm just thinking. So any other markets that? Interest rates, we kind of covered that. What about the dollar, right? You're trading dollars, right?
Yes, I am. And just cover on the interest rates real quick. I've been one of those that are beating the drum for the last 2 years that interest rates are not going to go higher for longer, and that the 10-year, I think that was, if you were buying a little early last year on the 10-year prices, then you were definitely uncomfortable in your seat, to say the least, in September. But it turned out to be a really great trade. And there's going to be another setup at some point. But right now, you have to get out of the way. I mean, you see the Fed getting that pricing in, the fact that they're likely not going to cut rates this year. Get that priced in. But then if we have to see the economy roll over after this little bit of a seasonally upbeat time, then those interest rates, they're going to go right back down. I mean, and we could see the 10-year at 2%. That's something that when you want to position for something in the market and you want to look at something as a long-term trade, you may not fade a rally in the 10-year at 270 and catch a whole move down to 290. I mean, sorry, down to 2%. But what you want to do is understand that you're entering a long-term trade. And that's the type of potential that could come from it. So that's really what you want to look at. You want to look at something like that. And the dollar, to go on your currencies, the dollar is not necessarily something like that. If you're looking at a longer term trade, there is some short term momentum, and the dollar is trying to break out above 98, the dollar index. But you're not going to have the drastic upside. There's a trend line going all the way back to 2000 in the dollar that comes in about 101. There's a nice little move there that we could see if this dollar index continues to get a closeout above 98. But, the upside, I think, if you're looking at a longer term basis, is going to be a little more limited there.
Yeah. Okay. Well, I find your perspective really interesting. Traders' perspective, so much different than an economist or just somebody who's knowledgeable about the economy or a business person. And that's why we love to get you guys on. So looking ahead though, economy in the U.S., we talked about the infrastructure bill. I think it'll probably go through. It's just a question of how much money they borrow. And that gets us to the deficit. So the deficit is doing nothing but going up. Can that continue? How much longer can that continue the way it's going here?
That's one of those chickens that are likely to come home to roost. And, as a trader, I started this, I was 16, 17 when I started trading. So I've just been trading for about 20 years now. And I've seen, quite a bit, but I'm learning more every single day. And when I really started doing futures, I felt like you could sit in front of the screen more and you could watch the ticks and you could trade. But I think the introduction of algos coming into the market over the last 10 years has really changed that landscape. And, I've gone from looking for shorter term timeframes to as I mentioned with that 10-year, you got to look for the longer term time frame, and you may not be catching that whole wide range, but you're catching a good chunk in between. So you want to look for something that can give you that whole wide range, and you're playing that narrative out until that narrative is proven fundamentally wrong or technically wrong. And so because of that, I've gone from wanting to be, or just being a trader 20 years ago, and then to the early part of my career, to slowly becoming more of an economist and trying to understand what's going on and what's moving things, because you have to have those longer term type views. And, right now, one of the things I think is most surprising, as you said, the deficit, and they continue to print money, and that means they're printing a larger supply. You're seeing more treasuries to raise that capital, raise that deficit. But for some reason, you're continuing to see the bids on those treasuries, and that right there. I think if you take that fundamental basis alone, that more supply is not pushing this market down. That's one of my bases on that. These rates are not going to rally for a while. These rates have lower to go.
Yeah, and we saw this in the Great Depression. Nobody really studies history anymore, but rates were like next to nothing, and really, they stayed there for the better part of 10 years because there wasn't demand for money, but except by the federal government, and they just printed it. They devalued the currency, breaking the link to gold or raising the price of gold, however you want to look at it, expropriating gold, whatever you want to call what they did, however misguided it might have been. It seemed like a good idea at the time, of course, but now, it's something has to give at some point, don't you think?
Yeah. Right. Well, right now, I think that you're seeing the turn off from recessionary fears, and you can see that the central banks are doing everything they can to throw at the economy in order to keep it from rolling over. And and that could work for a while. No one knows what the end game is going to be, and I'm not about to start guessing, but typically, what you would imagine, it's not going to be pretty. But again, I don't want to start guessing on how things could end. But I think you got to find the narratives that you feel comfortable with if you're trading these markets. And I think that the rates staying low is one of the only ways that the Fed, central banks around the world are going to be able to continue to battle a potential recession. And that's one of the things. That's one of the narratives that I like. One of the narratives I think you can trade against too. Just look at last year. That 3.25 was on the 10-year was the resistance on a technical basis and really on a fundamental basis, because that was the breaking point too for really the economy and in some ways. So I think you got to watch those rates. I think they're more important than ever right now.
Yeah. So that's where it's going to break. Assuming it does break, the rates will tell the story. I always have heard about these bond vigilantes, but I got to tell you, I've never met one. Have you ever met a bond vigilante?
No, I guess not. I guess I can't say I have.
I'm beginning to think maybe these guys don't really exist. Is that possible?
Yeah, maybe not.
That's like, hey, one question I want to ask you. Commitment of Traders Report, something you watch regularly, right?
Yes, of course.
Okay. So when we're looking at it, we've got the commercials and we got the speculators. And the speculators, I've been watching this thing for years, better part of 5-6 years. The speculators are always wrong, right? And yet they keep speculating. Do these speculators really exist? Who are these speculators? Are they just people that like to lose money?
Well, One of the things that I'm going to answer your question with kind of pushing in a different direction as well. One of the things as a brokerage firm that I'm trying to do is I want to build client relationships for a very long time. And by doing that, I work with clients hands on hand. I get clients as well. Maybe they're doing some of their own trading in another sub account, but we also want to bring in CTAs and CTAs to trade for these clients. So they have a diversified, say, portfolio of commodities and different traders and different perspectives. One of the hardest things to do is find a successful CTA. Now, there's a couple out there, and I've been grooming some relationships as well with some young CTAs that I've been helping clients allocate some funds to. But going back to the commitment of traders, the leveraged and the financials are on the leverage side, and the managed money on the commodity side. Those are the CTAs, and it seems like they're always behind the ball. I mean, always behind the curve. And it's as you said, it doesn't seem like they're making money, and they're not. That's where one of the most difficult things is. But I love looking at those committed traders because it does tell a story of where the market gets overcrowded, and you got to fade it. And you can see really where moves in crude oil, they're vicious moves down on days because the long side gets overcrowded. You saw that in October through December, but even you're seeing it sort of right now in a day like today, we're down $2, more than $2 as we're talking now, actually looking at the board. But wow. You don't want to chase anything that's and not protect your downside, because don't get me wrong. I mean, crude oil, you could rode the long side a bit longer last year through the middle part of the year, and it was a very overcrowded trade. But when you're joining an overcrowded side, you've got to protect your downside. And then outside of that, the 10-year, just going back to this, I mean, there is just massive shorts in that position in the prices. So I mean, I think that's another reason that why I'm so bullish on the longer term. Like, I'm not sitting here buying on a day like this, but in the longer term, is that there's going to be something that comes to fruition here with where these shorts are going to have to cover at some point.
Mm-hmm. Yeah, because we see these huge. I mean, how else do you describe them? The shorts, like in the silver market, we've seen it for years, right? And
yep.
At some point, what happens here? Something has to happen, right?
Yes, that's the chicken comes home to roost. Something has to happen.
And just
that was a great indicator for gold.
Yeah.
Coming around to a very seasonally bullish time of year in December. They actually very rarely you'll see gold get into a net short. And last year, and coming out of August, September, you had a net short position in gold and silver, and that was a great indicator to say this market was going to rally.
Yeah, very true. Hey, one other thing just about you. So you mentioned you've been doing this since you're 16, if I heard that right. Correct?
I've been trading 16, 17 when I started. Yeah.
Wow. So how'd you get into it?
I actually, I had to have been 10 years old when my grandfather had one of those old stock books. But I guess back in the day, it was really before my time, but everything, the stocks were all in a book, and I would sit there and he'd go through the stocks in the book, and that got me into things.
That was the S&P book. That was the S&P book. It was like a little 4 by 6 inch folded over, like a little bit better than newsprint quality paper. And you could spend hours. They had all, now you just pop a symbol in your computer and more than that book, could ever tell you. But it had how many years the dividend ran uninterrupted, dividends paid till, PE ratio. It had the balance sheet, at least in terms of equity, shareholders' equity. That was kind of like the good old days, wasn't it?
Yeah. That was as far as back as I remember. That I would just stare at that stuff with him. Before I really even understood it. So that got me into it, and I knew it was the place I wanted to be.
That's really great, and that brings back fond memories because so many of you out there, older people, at least over the age of 40, probably started off with your interest in the markets from the S&P stock book, and that just brought back some really fond memories. And hey, so we want to find out more about you, what you can do for us, all this good stuff. how do we connect with you here, Bill?
Well, our website, bluelinefutures.com, and we put out daily content. That's one of the things that we love to provide it for our clients. It's sort of like our trading journal. I personally write the S&P, crude oil, and gold that goes out daily. I have an agriculture expert that writes the corn, wheat, and soybeans. We also do livestock and FX. So we get all that stuff out there to our clients on a daily basis. They can sign up for a free trial to check out, what we bring. On our website, bluelinefutures.com, you can email me info@bluelinefutures.com. But when it comes to clearing, we have many clearing relationships. Depends what fits the client best. We have all the platform options anybody can imagine. So if somebody's on something and they want to move over here, whether it's try and find a better rate or just trying to get some support, we most likely will be able to get you on the same platform you currently have. So yeah, it's our real goal here is to provide great technology, great consistent research, and customer support. So it's, when somebody calls in, they're not sitting on hold forever to get somebody.
All right. Hey, well, it's fascinating. It's great to have you on. First time FSN guest. And if anybody's got any questions for Bill or myself, issues you want to raise, just write me KL@KerryLutz.com, Twitter feed @KerryLutz, Facebook page, Financial Survival Network. Whether you're listening to this through a podcast channel or YouTube, please subscribe, like, and share. Really helps me a lot when you do it. Helps get ideas out there like Bill's that you're just not going to run across every day. Even though you are on a lot of channels, Bill, I don't think you get to talk about what you really do in all of these markets like you did with us today. We really appreciate you coming on, and we will have you on again.
Thank you for having me. I look forward to joining you again soon.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.